Welcome back to another Wash Talk, the Car Wash Podcast. I'm your host, Rich DiPaolo, and joining me today we have Kenny Kraft, Managing Director, and Alex Feldman, Vice President of Houlihan Lokey. Alex and Kenny, so great to have you on the program here today.
Thank you for having us.
Absolutely. Yeah, I wanted to catch up on some of these evolving car wash industry trends and maybe get an overall market update. But can you give us a little bit of background first on what Houlihan Lokey does and maybe what you all do at the company?
Perfect. Yeah, I'd be glad to do that. And maybe I'll just start with a quick introduction on who I am, and I'll share a little bit about Houlihan Lokey as well. So I'm Kenny Kraft, and I'm the head of our multi-unit industry coverage practice at Houlihan Lokey, which is to say that I'm responsible for mergers and acquisitions, advisory, as well as capital raising for our corporate clients and private equity firms in the space. Just quick background on who I am. I've been working with various retail companies for nearly 2 decades. And joined Houlihan Lokey earlier this year from JP Morgan, another investment bank. And the specific sectors within kind of the multi-unit and retail categories where I spend time is I lead our practice in car wash, convenience stores, and restaurants specifically. And just a quick word on who Houlihan Lokey is. So we are a leading global investment bank. We carry expertise across a variety of disciplines, namely mergers and acquisitions, capital markets, financial restructuring, and financial and valuation advisory. And we're proud to say that in 2023 and for many years, we've been the undisputed leader in terms of number of transactions advised on across those 3 disciplines, corporate finance, restructuring, and finance and valuation advisory. Where we led in the league tables in 2023, as we have for many years. So that's a little bit about Houlihan. And Alex, I'll let you introduce yourself before we jump in.
Kenny, well, my background is less diverse than Kenny's. I've actually been at Houlihan my entire career. So I've worked in investment banking at Houlihan for the past decade. My fun fact, I love to say, is that I'm the oldest of 3 kids. And at one point in time, all 3 of my parents' children actually worked at Houlihan. So we love the firm. But let's get back to you, Rich, and our agenda. We could talk about HL all day.
All right. Sounds good. Yeah, definitely no shortage of advising and raising capital and mergers and acquisitions in this exciting car wash industry. I've been reporting on it for a little over a decade now. And in that past decade, we've seen so many changes. And I know you guys are keeping track of all these changes, and Houlihan Lokey puts out a study which we're happy to link in the description here of this podcast episode. But just over the years, just interviewing operators and vendors and consultants in this industry, certain terms are kind of thrown about. The car wash industry is recession resilient, and it's Amazon proof is another phrase I hear, and even unfortunately over the past 5 years, we've heard it pandemic resilient as well. So, a lot of operators during the darkest days of COVID were still reporting record traffic counts and whatnot. So, this industry has a propensity to perform better than others, I would say, during these ups and downs of the economy. So the U.S. car wash market has shown remarkable resiliency. What are the key factors from your viewpoint that have contributed to this resilience, especially in the face of economic fluctuations and external pressures?
Yeah, absolutely, Rich. And that's a great observation. And we certainly agree with your observation. We use that term resiliency quite often ourselves. So what I would say in response to that question is, it's kind of needless to say that the sector has garnered a massive amount of attention in recent years. And really since before the pandemic, 2018, 2019, and before that even, we've seen a tremendous amount of institutional investment flooding into the space. And I know that we'll talk more about M&A trends a little later on, but I'm an M&A banker, so naturally I tend to think about, the term resiliency from an investment mindset. And so my M&A mind kind of goes right to the question of, well, why do institutional capital sources like this space so much? And pulling back, when I think about the institutional investors that look at the car wash market, they tend to come from one of two industry backgrounds. They're either from a multi-unit, kind of retail-oriented background, or they look at the space from kind of the broader automotive ecosystem. What I would say about those two broader ecosystems where investors tend to have broad theses is that those sectors are not without their investment challenges. On the retail side, as you talked about some of the various elements of disruption and disintermediation, whether it's Amazon, pandemic, et cetera, we've seen a lot of disruption to traditional brick and mortar. And that's been going on for more than a decade at this point, whether it's e-commerce, disintermediation, evolving consumer preferences, a drive for more convenience, challenging operating environments over the years, skinny margins. And then on the automotive side, some of those risks that would be highlighted would be cyclicality concerns, OEM dependence, skinnier margins for certain operators, just general ebbs and flows of space. And for more combustion engine focused, automotive companies, the looming threat of EV disruption on the combustion engine or autonomous fleet disrupting repair and services, things like that. So when you look at car wash, it presents this very compelling area of investment between the Venn diagram, kind of those two circles, because of the resiliency point that you talked about. Relative to those broader categories. And we've seen very strong operating performance in the space through no shortage of operating challenges. So first we had, in the last 5 years, we had the pandemic where miles driven plummeted, yet car wash remained a very resilient category. We saw inflation, we've seen rising interest rates, corresponding rising cap rates, wages, chemical costs, all of these all of these inflationary measures impacting kind of the broader retail and automotive landscapes, yet the car wash market has continued to perform. So long-winded preamble to say, well, why is the space so resilient? And I'm probably telling your audience things they already know, but to put yourself in the seat of an investor in the space, what's really attractive is that recurring revenue model. Investors love the membership model. Lenders love the membership model. And sure, memberships can churn, but overall, knowing that the first of each month results in a very healthy portion of your earnings being automatically realized, that's, of course, of great appeal. Of course, there's strong unit economics and a lot of white space potential. And it's easy to point to the massive wave of development we've seen, and not necessarily see that we're still kind of in the nascency of the overall market. And to give you a data point, there's roughly 60,000 car washes in the U.S. today. I also cover the convenience store space, and not to say it's a perfect parallel, but they're both destinations where you seek out regularly for your car, and they're increasingly converging as well. But there's 150,000 gas stations in the U.S. And so, if you think about the relative penetration, there's a lot of white space ahead. And, the other thing that I would touch on is just the asset light nature of the operations, where obviously in the pandemic, that proved very beneficial. But when you think about, the asset light nature, self-service model, labor light, offering flexibility for the customer, and the proof is really in the financial profile. And just look at the EBITDA margins for the space, great operators are north of 30%. You don't see margins like that in a lot of these other categories. There's also some resiliency to the consumer itself. And Alex, I think I'll ask you to touch on some of those points.
Yeah, absolutely. What I'm about to say might be a bit of a controversial statement, but this is a relatively discretionary purchase. Car wash operator top lines are not completely isolated from the broader consumer pushback that most consumer companies are facing for. And there's only so much price that operators can take before they get pushed back from a traffic perspective. But when you look at car wash relative to other discretionary purchases, it's much more inelastic, right? You want your car to be clean, and you don't want to wash it at home, right? It's difficult to do. You waste a lot of water, and consumers are increasingly time constrained these days. So if you're investing in your car, it's a lot less expensive to invest in a wash than it is to buy, aftermarket accessories for a totally new vehicle. I liken it a bit to the cosmetic space. Cosmetic retailers have a long history of pointing towards being more recession resilient. And that's because in times when consumer budgets are strapped, consumers might pull back on things like buying a new dress or buying new shoes. But to feel good, they might splurge on a new lipstick. And I view car washing similar. If you aren't buying a car and you're not upfitting your current vehicle, you can still invest a modest amount of capital and have your car look nice. Lastly, it's just real convenience. Today's technologies make washing so easy. Washes are close to people's homes, no wait times, and consumers are increasingly looking for ways to just make their lives.
I appreciate that. Thank you both for the insightful response there. We certainly don't shy away from controversy on this program, Alex. So no need to worry about that. And my wife and I just actually returned from vacation. She forgot a few makeup items, and I could say firsthand that she wasn't shy to splurge to replace those things, right? So obviously this market, and you mentioned it, it's highly fragmented, and I know the convenience store industry is another market that you track, and certainly your study does as well. It's interesting. You talk about white space. The largest operator in the car wash industry only has about 500 locations, but when I looked at your study, if I'm not mistaken, it was 7-Eleven that has around 15,000 or even more locations, just to give a comparison of those two markets, and there's variety of reasons why that is, but can the consolidation trend, Kenny, you mentioned, so that's an area where you're laser focused on these days, and the M&A activity. Can you elaborate on some of the consolidation trends that we've noticed in the car wash industry over this past 5 to 7 years? What are the driving forces behind all of this ongoing M&A activity? How do you see this trend evolving in the near future?
Sure. Yeah. So we've seen billions of dollars flooding into the space from an M&A perspective in the last 5 years, and that's largely been driven by private equity investment. And if you really hone in on the timetable where that was front and center, it was kind of that 2020 to 21. And into early 22, we saw a rush of investment in the space. And that's because at the time, and it continues to prove itself to be very resilient. At the time, car wash was kind of the darling of both public and private equity markets there for some time. And that's a result of all those aforementioned factors that we were just talking about. So we were seeing in that time frame, investors coming into businesses at elevated multiples, and where many of these are public in nature, but high teens into the 20s of adjusted pro forma EBITDA multiples was kind of the accepted norm at the time. And there was also an increasing acceptance of run rate adjustments to the EBITDA that was being given credit in those processes, which those adjustments were giving credit for maturity ramp of recently opened units that hadn't hit its 4-wall maturity, getting credit for sites under construction as they open and come online, that those were kind of money good earnings, but in some cases some even more aggressive adjustments. So a very robust and healthy sellers market back up until kind of about 22. And what we've seen is a bit of a quieter space for platform investments since then. And some of that overzealousness and valuation caused a pullback in some activity here more recently. But it's a byproduct of a couple of things. It's not just valuation, but some of that is the fact that because there was so much investment that now we're just naturally in a period of digestion. There's also a bit of a shifting growth bias. So for existing PE platforms, where there are increasingly more platforms of scale in recent years, there's an evolving preference for developing new sites and growth through greenfield as a better means of earning return than acquiring existing platforms. And it's because you get the benefit of controlling your own branding, choosing your own sites, investing in the latest tech, kind of building by building. But really the largest reason why it's been quieter does get back to that valuation dynamic, which is if sellers have continued to see those multiples that were earned in processes a few years ago, and desire those outsized multiple outcomes for their businesses. Whereas for a variety of factors, including the broader macro environment and the cost of capital environment, buyers are recalibrating multiples in terms of their ability to pay, which of course makes sense at higher interest rates, higher cap rates. Kind of the other thing that we're seeing is a heightened scrutiny on those EBITDA adjustments and the kind of the current environment. So broadly speaking, it's been a relatively wider bid-ask spread here in recent years. And that's not to say there aren't deals getting done. What we are seeing get done right now is some smaller transactions, bolt-ons for those operators who see geographic or operational synergy to make an acquisition. We've seen structured investments or capital raises, raising new money to support greenfield development. Seeing new funds partnering with existing PE funds to kind of help drive growth. In many cases, those investments come in a preferred capacity where the new investor will have some form of a protected return ahead of common shareholders. But that's kind of the dynamic of what we're seeing right now in the M&A space. And I know we'll talk about our outlook for the future as well as part of this podcast. But our stance is it does feel like we're nearing a point where we're kind of turning the corner in M&A processes and expect 2025 to be a more active year for a variety of reasons.
We'll keep our eye on that movement. And actually, I'm not sure if you're familiar with our top 50 list, but I'm kind of in the right smack in the middle of all that research and trying to get that list ready for our December issue. And I've noticed those chains that are strong with greenfield development are moving up the list, even though that's a slower growth strategy than going out and acquiring a chain with a bunch of locations. But for this next question here, I think maybe I have recency bias or something. I was reading an article that Transchem wrote for our magazine on PFAS and the forever chemicals involved. So these car washes are maybe a little bit trickier than some might realize that they are to operate, and they've got all this in environmental considerations and regulatory things to consider. So in your opinions, how has enhanced regulatory impacted car wash operators in recent years? Are there any specific regulatory changes or maybe areas of compliance that are becoming more challenging for these businesses, would you say?
Kenny, maybe I'll take this and you jump in with anything that I missed. But, in terms of regulation, we see both headwinds and tailwinds. Regulation, the term carries this negative connotation, but there are certain regulations that actually help the car wash sector. In terms of regulatory tailwinds, the EV trend, great example. EV has regulatory oversight as the number of EVs continues to grow. No, EVs are not dominating the streets overnight by any stretch of the imagination, and the combustion engine is here to stay. But investors like car wash because it's EV and autonomous driving agnostic. EV and self-driving cars get just as dirty just as often as regular ICE vehicles. In terms of regulatory headwinds, the most prominent is probably, as you mentioned, permitting and municipality focus on modern capital usage. Now, there are, of course, processes to reclaim and recycle water, which provides for those closed-loop systems. And the EPA has come out and said that washing at a professional location is preferred to washing at home, say in your driveway, where the runoff impact is much higher. Additionally, the rapid growth of the sectors has caused many jurisdictions to cap the number of washes in any given region. And so that can be a barrier to entry and a competitive moat for operators who have already established a density. I think most M&A bankers are often asked about the regulatory impact of antitrust. And what I would say is from an FTC perspective, we have a long way to go before there's FTC scrutiny in a meaningful way. The FTC does look closely at convenience stores and that are highly fragmented space, going down to the street corner level to make sure that consumers are protected from a pricing perspective. But I think most operators would agree that there is plenty of free market competition in the wash space right now.
Cool. Anything else to add, Kenny, or ready to move on to?
No, Alex nailed it. I completely agree.
All right. So in terms of headwinds in this car wash industry, what do you see as some of the key maybe risks or challenges that could impact the industry's growth trajectory over these next 5 to 10 years?
Sure. So a couple things come to mind, and I'd say from an operating environment perspective, this sector is weathering some of those headwinds. Right now that we've already covered, like the rate environment, inflation, and really right now it's a wary consumer. But much better than some of the other industries where we spend time. And in part, it's because of the aforementioned resiliency that we talked about. But to give you a sense of some of those other kind of like longer term risks that we are actively monitoring and are starting to see come up in dialogue with investors just around thinking about how to kind of mitigate any investment risks. The first one that comes to mind is just overdevelopment, where unit growth has been so explosive in recent years. Rich, you mentioned that as you're assembling your top 50 and kind of the ever evolving landscape of players who are growing so fast. Certain of those markets that kind of come to mind, it tend to be Southeast and Southwest. And there's really kind of certain jurisdictions within those broader markets that are getting more saturated. And it's not all markets, but I'd say there's certainly a watchful eye in the industry on how kind of the 22 and 23 vintage, cohorts of washes that were developed are standing up to, some of their more historical peers in terms of unit economic performance, just to monitor that saturation level in certain, more competitive, dense markets. So that's one consideration. The other one always to be thinking about is just technological changes and shifts, just as another risk to the industry. These washes are incredibly expensive to build. You're talking about several $1 million in a location, and inclusive of real estate, they get even more expensive. And we've seen, obviously wash technologies and store formats evolve a ton over the last decade. So, anytime you've got kind of great technological innovations and washes get, more and more touchless and more efficient, things like that, it's just obsolescence risk as new technologies arise. Is that where remodels, reinvesting in your existing locations. But the silver lining is, for the most part, most of those innovations lately that we're seeing are more so on the chemical side, which have relatively lower energy costs and can be easily adapted. Another one to think about is just kind of some of those broader automotive secular risks, which these are probably more tailwinds for car wash than headwinds per se. But obviously EV disrupting the industry, less of an issue for wash. But other trends like autonomous or ride sharing, as fleets continue to evolve, could present risk just in terms of the overall car park. But as long as the car park keeps increasing, washes will be a prominent part of the industry. The last one, which often comes up in earnings calls, due diligence sessions, et cetera, is just, such a watchful eye on the weather. And yeah, we aren't climate scientists, so it's hard to opine on the threat of, prolonged rains or anything like that being a super tangible headwind. But it's something I'd be remiss if been raised as part of just kind of ongoing, a risk mitigation mindset as people look at, where they're developing. But don't get us wrong. I mean, the sector still remains relatively young, and we see a lot of growth ahead.
Yeah, once the Express Exterior format came into to popularity, and then you mix that with the unlimited programs, it was certainly a market that private equity and large investors became attracted to rather quickly. But as these investors have entered the industry and these trends have played out, I'm curious, as we sit here today in quarter four of 2024 here, what is the viewpoint of private equity on this car wash industry? Are you seeing more investors interested in this sector due to its resiliency, or are you seeing them hesitating and pulling back in any way?
When you talk about private equity investment, you also have to talk about financing. So I'll start with financing and I'll kick private equity and investment to Kenny. But, from a financing perspective, obviously the heightened rate environment and the corresponding higher cap rate environment, not to mention the trickle down costs of construction, has created a higher return threshold for financing sources. And that's made borrowing costs more challenging. We still see plenty of appetite from credit sources and real estate partners for assets in space. The market is simply having to bear those more elevated costs. Of course, we've seen one rate cut so far this year, and the market is looking to the Fed in November for further action. So with rate cuts should come an improved financing environment for operators. So, we'll see.
Yeah. And then from an investment perspective, what I would say is, and kind of starting with just where our perspective is grounded. So at Houlihan Lokey, we have the largest and most active private equity coverage practice on Wall Street. So we're talking to private equity firms about this space literally every day. And what I would say is that, while, as we talked about, we haven't seen, a lot of new platform deals lately, there's still plenty of private equity firm and family office interest in the space. So, investors want to find a new platform. What I'd say is we just find ourselves in a more discerning market from an EBITDA perspective and a multiple perspective than we were in before. All told, I think valuations, we need to see some valuation markers at kind of a more normalized level in terms of where buyers and sellers are in the current environment before we see a big push to the market, kind of a growing acceptance of what that more mature valuation looks like for private company operators. But overall, I'm optimistic about 2025 as it relates to the water space. Assuming the economy normalizes, the rate environment improves, and operators continue to prove out their merit, we suspect you'll start to see more investment in the space. So, that kind of lays out the overall perspective on kind of where we're looking ahead. And the only other thing I would just say is, when I talk about discernment in terms of diligence and valuation and EBITDA credit, it's really important for operators who are seeking to go to market to have a very strong grasp on a cohort level of their data. And we can talk about that here in a minute, but it's just incredibly important to have a strong grasp down to the site level of wash performance, competitive dynamics, et cetera.
Very interesting. Yeah, and that's great news for the car wash industry and its short-term future. And I think it was Kenny who mentioned earlier in our interview today, there's tens of thousands of car wash locations in the United States. But when you look at the biggest chains in our industry, they only account for a few, maybe a couple of thousand locations. So it's still a very highly fragmented industry, still made up largely of let's say, smaller chains or mom and pop locations. So basically investors and car wash owners and operators, all different walks of life and all different journeys on their in their careers. So, given the current market environment and the regulatory landscape, which we've talked about, what advice would you give to car wash operators generally, either looking to scale or maybe even prepare their business to exit in these next few years here?
Yeah, that's a great question. So just a few points of advice for operators that are thinking about or planning an exit. The first, and this is kind of because there's been so much M&A in this space, is leverage kind of the precedents that drove investment in some of the market darlings. Look at their value drivers as kind of a roadmap for your exit. And a few of those value drivers that come to mind as I think about is, what resonates with investors is branding, mono-branded concepts with a market resonant brand. We've seen success for multi-branded as well as mono-branded, but we tend to see mono-brand with a specific kind of market ownership emerge as the darling, particularly if they're offering consistency of experience and format. Location, the age-old real estate adage, which is site selection, is just so critical and so important. And we're starting to see some of the bifurcation of trends between a strong traffic site versus a lesser one put in the wrong location, maybe for the purposes of scaling fast, or maybe because it was an opportunistic site or something like that. So the unit economics are starting to kind of bifurcate a bit more. Around that branding point, I just think market density is another just really critical element, which is building a moat around a specific market to drive that membership growth. We've seen studies where consumers are more inclined to join a membership program when there are multiple sites nearby and there's that ease of convenience for your day-to-day commute. And that branding resonates better in a market when you've got multiple sites in great locations. But that's not to say don't just dominate one existing market. Portability is also very important. So kind of prove that your brand can travel to another adjacent market. And then the last thing I would say in terms of those value drivers is loyalty programs, use of technology kind of broadly, staying on trend there. That's another helpful kind of driver. From a real estate perspective, we often get asked, is it better to own or lease our real estate? Interestingly enough, evaluations from a few years ago, owned versus leased, there was a bit more agnosticism by investors because the operating company multiples were so high. But I would say, I tend to be a little more conservative in nature, erring on the side of owning your real estate, kind of having that rainy day lever. It's nice to have it. But obviously you build the suit, sale leasebacks at the right kind of market terms could be very efficient, helpful ways to help you scale. So there's certainly two sides to the equation. And then most importantly, and perhaps somewhat self-servingly, but some advice if you're looking to exit is I'd say hire an advisor early in your decisioning. You don't want to just bring someone in and say, okay, we're ready to go to market. I've noticed that in recent years, particularly in some of the more challenging market conditions we've witnessed in the last 2 years, that we've been getting folded into processes, in some cases, maybe even more than a year before we bring a company to market. But it's good to know how strategic decisions that operators are making ahead of launching the sale process can impact buyer receptivity in your transaction. So, it's critical to assemble a good team of not only your M&A banker, but also corporate lawyers, other consultants like environmental, real estate, et cetera, ahead of formally launching a process. And then I'd say related to that, just be ready and be flexible and adaptable around your exit timing alternatives, because markets can adapt quickly and you don't want to be starting your exit prep when you find a favorable window. And then just the last thing I would say is, and I touched on this a little bit earlier, but know your markets and your competitors and your store performance inside and out. And I'll give you an example of what I mean. So since I joined Houlihan Lokey, I've been blown away by some of the data analytics and capabilities that we have. So in particular, we have a group of data scientists that sit within our transaction advisory team called our digital value creation. And what they'll do is they'll scrape operating data, plug right into a POS, and unpack operator trends. And so we worked on a car wash deal recently where our DVC colleagues, they were unpacking operator traffic trends, competitor traffic trends, the weather, market demographic information like income, education, gender, you name it, performance by geography, performance by store opening vintage, by type of location, and looking at statistical correlations of kind of what drives EBITDA generation. And it really just helps substantiate the financial information that buyers are seeing. So those are some of the types of things that I would say are really key as you prep and exit. The only other thing I would add is just from a size perspective. This is a market where, as you said, it's still relatively, in its nascency, and it's very much fragmented. And we get a lot of questions of like, what's the right time and when are we the right size to go to market to attract a lot of interested parties? And all I would say there is, the liquidity for lower mid-market and mid-market companies can present a variety of exit alternatives in a deep pool of investors. The bigger you get, that pool shrinks, of course. And so, don't be shy to engage with advisors maybe earlier in your growth cycle than you thought about, because there could be a deep market for you. And, it's important to be thinking about, even if they say, hey, go build 5 more units, 10 more units, whatever it may be, it's important to kind of be having those conversations.
Well, that's great. And I've certainly enjoyed the research study that your firm puts out. A lot of hard work by those data scientists and researchers going into that report. We'll put a link to it in the description here of this podcast episode. And for those looking to stay in the business, I'd be remiss to just call back something Alex said. And why do people go to a car wash? It's to make them feel good, right? So you don't want to lose sight for those actually staying in the business. The same thing that mattered to customers 40 years ago still matter to them today. It's a clean, dry, and shiny car. So you want to lock in on those operations and make sure your customer service is top notch, right, guys? So I appreciate you both taking some time to discuss some of these evolving trends. It's definitely an interesting market that our publication and website serves, and bringing in experts such as you, Alex, and Kenny, definitely help us keep operators informed. So thank you very much for taking some time today.
Sterling, thank you.